At this very moment, while the world remains distracted by the flickering screens of mainstream media, a massive financial shift is taking place right under your nose. If you pull up your charts today, February 2026, you will see silver priced at $74 per ounce. But if you glance at the live feed from the Shanghai Gold Exchange, that exact same metal, the same physical substance, the same atomic structure, the same signature 107.87 atomic mass, is trading for $86. That is a $12 discrepancy on a single ounce of bullion. Why is no one on the financial news networks discussing this? Why isn't a single anchor pausing their broadcast to explain the implications of a $12 arbitrage spread on the most critical industrial metal on the planet? The truth is startling. If they actually walked you through the mechanics of what is happening between Manhattan and Shanghai, you would immediately disconnect your TV drive to your nearest coin shop and buy every remaining gram of silver they have in stock. But you would likely find the shelves bare. The metal is already gone. It moved to the east. I'm going to prove this to you with hard data over the next hour. Stay with me. The corporate lawyers require me to say this isn't financial advice. Of course it isn't. This is an emergency roadmap for a collapsing arena. Do your own investigation if you still have faith in the institutions that eroded your purchasing power. Everything I'm about to show you is pulled from transparent data sets. COMEX vault logs, Shanghai settlement, prices, international trade flows, and the basic arithmetic they stopped teaching in schools around the same time they stopped explaining what real money actually is. I am Commodityadvisor. This is the archive. Let's dive in. Before we go further, consider the current state of digital suppression in 2026. You know what is happening. The filtering of economic analysis that challenges the approved narrative has reached levels that felt like science fiction just 5 years ago. My last 3 investigations into COMEX silver depletion were instantly buried by the platform's distribution filters. I have watched the engagement drop by half in real time. So if you are seeing this now, you successfully navigated the gatekeepers. Hit that like button. This isn't for me. It's to break the digital gag. Every interaction forces the software to show this data to people who need to hear it. If 10,000 people hit that button in the first hour, the suppression fails. This is our only tool for resistance. Click it now, then come back. Because what I am about to reveal regarding this $12 gap will permanently change how you view every financial headline for the rest of your life. Let's build this from the foundation. The SGE premium, what is it? Why does it exist? And why is a $12 gap a full-blown crisis signal? Historically, this kind of discrepancy precedes a supply shock or a monetary event. First, understand the setup. There are 2 primary hubs for silver pricing globally. You have the COMEX in New York, the Western Standard, and the Shanghai Gold Exchange, which has spent years positioning itself as the Eastern alternative. Here is the detail most analysts ignore. These markets are fundamentally different. The COMEX is mostly a venue for trading paper contracts, where nearly 98% of trades are settled in cash without any metal moving. The Shanghai Exchange, by law, requires a high rate of physical delivery. When Eastern buyers go there, they want tangible bars. This means a $12 SGE premium isn't just a glitch. It is a live admission that the physical metal available for delivery in Asia is far scarcer than the digital price in America suggests. The Western price claims 74. The physical reality in Shanghai says 86. The premium is the lie detector, and right now it is screaming. We have seen this before. In late 2013, gold premiums in Shanghai hit $50 over London. Experts called it a glitch. A few months later, Western gold stocks dropped by a third. In 2020, silver premiums exploded during the supply chain freezes. Silver eventually tripled in value. The premium was the warning. And in 2024, during what I call the Great Paper Divorce, the premium held between $4 and $7. Today we are at 12. That is double the previous crisis level. I want to explain how this arbitrage actually works, because it's the reason your local dealer is out of stock. This is the physical leak I've been tracking for 18 months. Imagine a major Western bank. They have silver in London or Delaware vaults. They see the gap. They can source silver at 74 and sell it in Shanghai for 86. Even after shipping, insurance, and taxes, which cost about $2 an ounce, they are netting $10 in pure profit per ounce. And they are doing this at a massive scale. Moving just 50 tons a week generates $16 million in weekly profit. They will run this trade until the vaults are empty. Why does the gap stay open? Because Chinese demand is structural. Western analysts think a slow economy will kill demand, but they are wrong. A huge portion of Eastern silver use isn't for jewelry. It is strategic stockpiling. These are government-level decisions. When Beijing decides they need silver for solar panels, missile systems, or 5G networks, they don't care about the price. They are buying silver because they've determined they need it before someone else can block them. China owns 80% of solar production. Each panel needs 20 grams of silver. There is no substitute. Combine that with their secret monetary reserve buildup, where they are quietly trading dollars for hard assets, and you see why the drain won't stop. Let's look at the math of the vault depletion. The COMEX registered inventory, the silver actually available for delivery, is currently around 170 million ounces. That sounds like a lot until you look at the paper market. There are over 800 million ounces of silver promised on paper contracts. That is a 5-to-1 ratio. When you include the London market, where the same bar is often pledged as collateral to multiple people, the ratio is likely 300-to-1. The whole system depends on no one asking for their metal. The Shanghai premium is the sign that the world is finally asking. At the current rate of drainage, roughly 10 million ounces a month, Western vaults could hit a breaking point in less than a year and a half. What happens when the vault hits the danger zone below 80 million ounces? The system has two choices. Either the New York price skyrockets to stop the eastern drain, or the COMEX declares a force majeure. That is a legal way of saying they are empty and will pay you in cash instead of metal. If that happens, physical silver will detach from the paper price instantly. We could see prices jump hundreds of dollars overnight. I will issue an emergency alert here the moment inventories hit that floor. Make sure your notifications are on. You need that 12-hour head start before the mainstream media catches up. The geopolitical situation adds even more fuel to the fire. Our national debt is $37 trillion, while our GDP is $28 trillion. That is a 130% ratio. Foreign buyers are walking away from our debt. China has already dumped hundreds of billions in treasuries. Where is that money going? Into real physical assets: silver, copper, and infrastructure. They are trading paper promises for physical power. Meanwhile, modern warfare is hungry for silver. Every drone, missile, and sensor needs it. Every nation rearming right now is competing for a shrinking supply. Then you have Basel IV. These are new global banking rules that make it much more expensive for banks to hold paper silver positions. The institutions that have suppressed the silver price for 40 years are now being forced by their own regulators to close their shorts. It is a slow-motion squeeze that no one is reporting on. And with central bank digital currencies on the horizon, the need for private, tangible wealth has never been higher. You cannot program a silver coin. You cannot flip a digital kill switch on a bar of metal in your safe. Silver is the ultimate exit from a digital cage. If you already own physical silver, you are positioned correctly. You own the truth in a world of digital fiction. If you're holding paper ETFs, you need to read the fine print and understand who actually controls the metal. If you think $74 is too high, remember the $12 premium. The market in the East is already telling you what the real value is. I'm aligning my own portfolio with the Eastern price discovery rather than the Western paper market. I share the specifics of my strategy with my insider tier because those moves require deep context. To summarize, the $12 gap is a signal. The drain is real. The paper to physical ratio is unsustainable. Basel IV is removing the suppression, and China is buying with no regard for the price. This is the moment of reckoning we have been discussing. What are you seeing on the ground? What is the real premium at your local shop today? Tell me in the comments. Your data is better than any bank report. It helps our community see the truth. I am Commodityadvisor. Keep your eyes on the premium and your hands on the metal. The archive is closed for now. We will speak again when the next inventory report drops. The mechanics of the silver market are often intentionally obscured by complex jargon, but at its core, it is a simple battle between those who own the physical atoms and those who own the digital promises. In the West, we have been conditioned to believe that the price on a screen is the ultimate reality. We check our brokerage accounts and see a number, and we assume that number represents a liquid, tangible asset. But as we have seen in every financial crisis from 1929 to 2008, the transition from paper wealth to physical reality is often a violent one. The current gap between New York and Shanghai is the first crack in the dam. When the dam breaks, the rush for the exits will be unlike anything we have seen in our lifetimes. Consider the role of the bullion banks in this environment. For decades, these institutions have operated in a world of high-frequency trading and algorithmic price suppression. They have used the leverage of the paper markets to keep the price of silver artificially low, which in turn has allowed industrial users to source cheap raw materials. But that game is ending because the physical supply is no longer sufficient to back the paper leverage. You cannot build a solar panel out of a futures contract. You cannot guide a missile with a digital derivative. The industrial world requires the actual metal, and for the first time in modern history, the industrial world is competing directly with the monetary world for a finite resource. This competition is what is driving the volatility we are seeing in the premiums. When you go to a coin dealer and they ask for $20 over the spot price for a silver eagle, they aren't being greedy. They are reflecting the reality of the wholesale market. They are telling you that they cannot source the metal at the paper price. They are essentially operating on the Shanghai price plus a local markup. The fact that the official spot price hasn't moved to reflect this is a testament to the power of the paper suppression, But it is also a testament to how close that suppression is to total failure. We must also look at the mining sector. Global silver production has been stagnant for years. Most silver is produced as a byproduct of lead, zinc, and copper mining. This means that even if the price of silver doubles, you cannot simply flip a switch and increase production. You have to wait for the primary metal mines to expand, which takes years of environmental permitting and capital investment. We are looking at a structural deficit that cannot be fixed by the market in the short term. This is why the strategic accumulation by China is so dangerous for the Western system. They are taking the surplus that would normally buffer the market and locking it away in private vaults. As we move further into 2026, the pressure on the dollar will only increase. With the BRICS nations moving toward a gold-backed settlement system, the global demand for dollars is on a permanent decline. When those dollars come home to the United States, they will drive inflation to levels that will make the 2022 spike look like a minor inconvenience. In that environment, silver isn't just a commodity. It is a lifeboat. It is one of the few assets that has zero counterparty risk and a 6,000-year track record of preserving wealth through the collapse of empires. The window to act is closing. Every ounce that moves to Shanghai is an ounce that is no longer available to you at a reasonable price. The $12 gap is your final warning. It is the market giving you a head start before the rest of the world realizes that the paper price is a fraud. Don't wait for the mainstream media to tell you it's time to buy. By the time they do, there will be nothing left to buy. Take control of your financial future today. Verify the data, trust the math, and protect your family. I will continue to monitor the flows and provide you with the most accurate information available. We are in this together. Stay vigilant. In closing, reflect on the history of the silver to gold ratio. Historically, this ratio sat at 15-1. Today, it is wildly distorted. This distortion is another sign of the paper market's influence. As the paper market fails, we should expect the ratio to return to its historical norms, which would imply a silver price much higher than even the current Shanghai premium suggests. We are living through a historical anomaly, a brief period where the true value of money is hidden by digital noise. But the noise is fading, and the signal is getting louder every day. Thank you for being part of this community. Your support allows me to continue this work and bring these truths to light. Like, share, and subscribe to ensure you never miss an update. This is Commodity Advisor, signing off from the archive.